This is a presentation on standard costing. Now, standard costing is a process where management establishes expectations about the use of its business resources, in this case a production process, and then subsequently periodic analysis to determine the reasons why the actual results, in other words the actual results of production, differed from management's expectations, and we call these differences variances. You'll see that term come up many times during this presentation. Now, management creates expectations for performance, again, as I mentioned, in the production process, and these expectations are what we would call typically under normal operating conditions. In other words, what we would expect on the average. These expectations are embodied in a term we call standards, or a standard. Standards are established for each type of unit of production. Now, the standards are going to help tell us how much should each unit of direct materials, in effect raw materials, cost. We're going to have to purchase raw materials to make our unit. Therefore, we have to determine how much those materials are going to cost up front. So we ask, how much should each unit of direct materials, raw materials, cost? And also, how much material should we actually use when we're making the unit? Number two, how should each hour of direct labor cost? So how much should each hour of direct labor actually cost? Should it cost $10 an hour, $20 an hour, so forth? In other words, how much do we plan to pay the production workers, and how much direct labor should actually be incurred? In other words, we should know how much time it will take to make a particular product. Lastly then, is how much overhead was over or under applied to production based upon variances between actual and estimated cost drivers and between actual and estimated overhead. And we'll get into that actually fairly deeply in a little while. In order to understand standard cost, it's probably best to illustrate the process of developing a standard costing schedule for at least, let's assume, one product. Here we have Acme, who's reviewed its production operations, and based upon the review of its normal production activity, Acme should be using the following resources in producing each unit. Now, I didn't mention what the unit is. It could be a car, it could be a truck, it could be a widget. It doesn't matter. We're just talking about one production unit. The company expects to pay $8 a pound for raw materials during the year. So apparently our raw materials we purchase by the pound. We also expect to incur a labor rate of $10 an hour for production workers, and we also expect to allocate $15 per labor hour of factory overhead cost to all of our units that we produce. Now, to produce one unit, the company expects to use, in terms of resources, 4 pounds of raw materials to make one unit, 3 hours of direct labor, and of course we're going to add in the 3 hours of overhead applied at again at our direct labor hour. So now let's take a look at how we build a standard cost. Okay, here over on the bottom right hand corner, I've created a standard cost schedule for one unit of production. You'll notice it includes raw materials, direct labor, and overhead. Now, our unit standard cost is basically an estimated or a predetermined cost of performing an operation or producing a good or service. Again, importantly, under normal operating conditions. Now let's go ahead and take a look at how this works. First of all, let's take a look at raw materials. Okay, raw materials, we want to determine the expected cost of materials and the expected amount of materials to be used in production. That goes into our standard cost. We expected to pay $8 per pound for those raw materials, so we put in the cost of $8 a pound. That's a standard cost for our raw materials. We also expect to use 4 pounds of raw materials in producing one product. So in this case, we show our raw material cost per pound of $8 a pound times 4 pounds of raw materials used means the total cost of raw materials within this particular unit is $32. Now let's go on and take a look at direct labor. Direct labor includes the expected labor rate, in other words, what we plan to pay people, and the expected amount of time that we basically have estimated to be spent on one unit. So again, if we look at our narrative up above, we expect to incur a labor rate of $10 an hour. Also, we expect it will take 3 hours of direct labor to complete one unit. So the $10 per hour standard labor rate times 3 standard hours to complete one unit equals $30. So there will be $30 of standard labor in each unit of production. Lastly, we have overhead. And overhead is basically the amount of overhead applied to each unit based upon our total estimated overhead cost and our estimated total cost driver units, in this case labor hours for one unit. Now that's a lot of information, and unfortunately overhead variances or overhead costs can be a little bit complicated. We'll go over them in detail during our presentation. So we see our overhead application rate is $15 a unit, and we said that we're going to apply overhead based upon the amount of direct labor it takes to make one unit, which is 3 hours. So $15 per predetermined overhead rate times 3 hours equals $45 worth of overhead is incorporated into this one unit of production. So we add all the units to all the costs together, the $32, the $30, and the $45, and we come up to a total standard cost $107. So we expect the company, the cost of this unit to cost us under normal operating conditions $107. Now, let's talk about how we calculate variances. And variances occur when our actual production results differ from our expectations. In other words, our standards. The first thing we're going to do is do a very quick illustration of materials variances in a 10,000 foot level of how we compute them. Okay, assuming we make an actual purchase of materials from an outside supplier, when we do that, we can compare the cost of the actual purchase that we from the supplier to what we expected the cost to be, in effect the standard cost. And if it is different, we produce a materials purchase price variance, and that variance represents the difference between what we thought it would cost versus what it actually did cost. Now at that point in time, we're going to take and remove that variance out of our actual purchases, and we're going to transfer our cost of materials not at its actual cost but at its standard cost, and we'll transfer that into materials inventory at its standard cost. At a point then we're going to have to take those materials out of inventory and use them for production. So we take materials out of inventory, and then materials that we actually use for production, we're going to compare the cost of the materials that we actually used in production versus the amount of material that we expected to use in production, because we created a standard for that. You'll remember that from our previous slides. Now, in the case that the materials that we actually use differs from the amount that we expected to use, that creates what we call a materials usage variance. And that materials usage variance is identified, and the only thing now we pass through in terms of materials is the standard cost of the materials at their standard usage. So only the standard materials at standard then get passed on to work in process. So the only amount in work in process are the amount of materials we expected to use at our expected price. So that's a 10,000 foot view of what we call materials variance as a material purchase variance, purchase price variance, and the materials usage variance. Now let's look at labor variances. We start out with actual payroll, and actual payroll is the actual hours of the production workers times the rate that we pay them. And when we do that, what we do is we compare the actual rate we paid them in payroll versus what we had expected to pay them. In other words, our standard labor rate. So we compare what we actually paid them per hour times the standard rate we expected to pay them per hour. The difference between the two is going to result in a labor variance, and that labor variance is going to be removed from our cost flow through inventory. Okay, now we go on. After we've extracted the labor rate variance, now we take a look and we need to compare the cost of the labor actually incurred versus the amount of labor cost expected to be used based upon the volume of units produced. So we have a standard in terms of we're going to pay somebody a standard dollar amount, and it's going to take them so many hours of labor to make the unit. So we use that and we compare that to our actual labor cost, and we come up with what we call a labor efficiency standard. And that labor efficiency standard, just like the labor rate variance, is extracted as part of the cost flow. Now, what we have left over after we extract the two variances with the remaining cost, that is the cost of expected labor that should have been used for the volumes or for the volume of units produced. So what we're saying is we're taking our standard labor rate times the standard hours that we expected to take for that unit to be produced. So what happens is that amount goes into work in process. So our labor costs go in at standard cost. Now let's take a look at overhead variances, and we're going to start at a very simplified level on overhead variances because they can get slightly complicated. First of all, we start out with the actual overhead incurred, and you'll remember we typically have, when we create a overhead allocation system in a manufacturing system, what we do is we apply what we estimated overhead would be for the year based upon an estimated cost driver. So we're going to apply our overhead to work in process, so what we call a POHR, predetermined overhead rate. Later on, we're going to compare that to the actual overhead we incurred and determine whether or not we over or under applied overhead. So right now, let's take a look. We take our actual overhead that we've incurred by the end of the year, and we're going to compare the actual overhead, basically the actual overhead incurred to the overhead applied using our predetermined overhead rate. And from that, we're going to produce overhead variances. Now, that's a very simplified concept at this point. If our actual overhead is higher than the amount we applied, then at that case, we've underapplied overhead. If our actual overhead is lower than what we applied, that is overapplied overhead. So when we apply our overhead, our predetermined overhead rate, that overhead is applied to work in process. And again, this will become more complex. These overhead variances will become more complex as we go on. Okay, now we're going to look at materials variances again, but we're going to move down from that 10,000 foot level. And again, you can see a very simple flow chart of basically the purchase of materials and the incorporation of materials into work in process. So we start out over on the left with the purchase of materials, and of course that's going to be at our actual cost. From that then we're going to extract what we call the materials purchase variance. After that then, the materials then, actually the value of the materials goes into our materials inventory account, but since we've extracted the materials purchase variance, it goes in at the standard cost. After that then, we're going to use the materials in our work in process, and again we're going to compare the materials that we actually used in our work in process versus the amount of materials we should have used, and we extract what we call a material usage variance. So the only thing that ends up in work in process is the standard amount of materials that we should have used at the standard cost. Now let's take a look at how we actually extract the material purchase variance. On the left side we have actual purchase cost, and that is our actual quantity times our actual price. So that's the actual amount. The second box, the one on the right, says cost if purchased at standard cost. So we create this cost that we call, if we actually purchase this at the cost we plan to, what would have been that cost? So that is the actual quantity that we purchased, but instead the actual quantity times our expected cost, which is our standard cost. Now, if in a perfect world there'd be no difference, because we purchase for exactly what we expected to purchase the materials for. But in the real world, that's pretty much never the case. So when we compare these two, we end up with what we call the material purchase price variance. And the variance can be either not necessarily positive or negative. It can be what we call favorable or unfavorable. Now, this is a term we give based upon which way the variance goes. It doesn't mean plus or minus. It just means favorable or unfavorable. And here's how it works. We look at our actual purchase cost, and we look at the cost if we purchased it at standard. So in effect, we're saying on the left side, that's what we actually spent. On the right side, that is what we expected to spend. So if the actual cost itself is higher than we expected to spend, that would be an unfavorable variance because we spent more than we expected. On the other hand, if the actual cost is lower than the amount that we expected, that would be considered a favorable variance. So again, don't think as favorable or unfavorable as plus or minus. Think of them relative to the actual result versus the expected result. Now let's go a little bit further in terms of creating or calculating a materials usage variance. The materials usage variance is the cost of the actual materials that we used. Okay, the cost of the actual materials that we used, but we price them at standard cost. So it's actual materials used times standard cost. And the reason we use standard cost is, remember, we've extracted the actual cost as part of our materials price variance, so we have to use standard cost. So on the left side, it's the cost of materials that we actually used at our standard. In other words, how much materials do we actually use in production? We compare that then to the cost of materials that we would have used if the standard amount of materials was used. In other words, based upon the volume of the work in process, we should have used, according to our standards, a certain amount of materials. And that's basically those are the materials that we expected to use. So on the left-hand side of the box, we have the actual usage, and on the right-hand side, we have the expected usage. We compare the two, and again, differences would result in what we call a material usage variance. And that variance can either be favorable or unfavorable based upon the differences here. So if the left side being the actual materials that we used and the right side being the expected, if we used more materials than we expected, that would be unfavorable because we used more than we should have. On the other hand, if we use less materials than expected, that would be favorable because we used less materials than we had expected. That results in either the material usage variance. Now let's look at labor variances, and you see two objects here on your screen. One says labor input, and that is basically our labor input at actual, which means our actual hours times what we actually paid people. Over on the right hand side you see work in process, and that's where we record our labor, but at a standard rate and at a standard cost. So that's work in process recorded at standard. So in order to get between the two, we have to extract several variances. So let's talk about the first variance we're going to extract. First one is called the labor rate variance, and I've illustrated the calculation here in a box format, the same as what I had done for material variances. The left-hand box, you can see it says actual labor cost incurred. In other words, that's the actual payroll that we paid, and that's the actual labor hours times the actual labor rate. On the right-hand side, on the right box, we have our actual labor hours incurred, but now we convert those actual labor hours in terms of cost to standard labor cost. So what we're saying here is, on the left side, this is our actual payroll, and on the right hand side, this represents the payroll we expected to pay, because we expected to pay at a certain hourly rate. Okay, so we compare the two, and we end up with a labor rate variance. And again, a labor rate variance can either be favorable or unfavorable. And the way you have to look at this, again, is not plus or minus. You have to look at it as compared to what actually occurred versus what we expected to have incurred. And in this case, if we take a look, the left-hand side being actual is the amount that we had that actually occurred. On the right hand side is the amount of labor cost in terms of labor rate that we expected to occur. So if our labor cost is higher than our expected, in that case it would be unfavorable. If our labor cost, actual labor cost, is lower than what we expected, it would be favorable. Okay, we have a second labor variance that we have to extract in order to get to work in process at standard, and that's what we call the labor efficiency variance. And the calculation incorporates the middle box, and we have another box over here on the right. Let's describe what that box on the right is. That indicates the labor hours that we should have incurred, call them standard hours, at the standard labor cost. In other words, we have a certain amount of production that occurred, and based upon that amount of production, we should have incurred an expected amount of labor hours or standard hours, and that would be basically our expected standard cost. So it's our standard labor hours times the standard labor rate. So now we compare the actual hours that we spent times our standard labor cost. And the reason we use a standard labor cost is, remember, we've already extracted the labor rate variance, so we need to use a standard labor rate. So we take our actual, the middle box now, in this case that becomes our actual labor hours, we compare it to the costs that should have been incurred, and we come up with some form of a variance. And again, if our actual hours are greater, that would be unfavorable, and if they are less, that would be favorable. Okay, let's go on now. Let's talk about standard cost and overhead variances. Now, we're going to start at a very high level on overhead variances, and then over time during this presentation drill down to where these variances become actually fairly complicated. I can tell you up front, these probably will be confusing, and you may not be able to master them all. However, you can take some type of a good feeling in that probably the portion of the exam devoted to overhead variances will be probably small or de minimis. So let's go with the standard, again, overhead variances. Okay, now overhead is normally applied to work in process based upon a predetermined overhead rate, and that's a I call it the PDOR. It's also called the POHR. Either one works, but in this case I've used PDOR. So overhead is normally applied to work in process using a predetermined overhead rate. Management must select the best basis for allocating this overhead cost to work in process. This basis is called a cost driver, and the cost drivers can be labor hours, machine hours, square footage, can almost be anything that management feels is a reasonable allocation of overhead to work in process. Now, the predetermined overhead rate is estimated at the beginning of the year, as is the estimated cost driver. So in order to calculate the PDOR, the POHR, either one, you can see the formula here where we take our estimated fixed overhead cost and our estimated variable overhead costs, if you will, and we divide that by the estimated cost driver units, whatever those may be. Again, could be labor hours, could be some sort of physical production, square footage, machine hours, etc., etc., etc. So in order to calculate our rate, we come up with our rate per whatever unit of cost driver by using that formula. Now, if we take a look at the actual overhead incurred, what we can see is we basically have a fairly simple way of calculating an overall overhead variance. On the left-hand side represents the actual factory overhead incurred, and remember that we don't know what the actual is until we actually complete the entire year. So the actual factory overhead incurred, we compare that to the overhead that was applied to production. In other words, the actual cost driver quantity used times the predetermined overhead rate. So if we look at the left side, that's the amount that we actually incurred for the year, and on the right side, this is the amount that we applied to work in process utilizing that predetermined overhead rate. So in the end, if we compare the actual to what was applied, we end up with an overhead variance. And basically what that means is that represents the amount of overhead that we have either over applied or under applied. As an example, if our actual factory overhead was less than the amount of overhead that was applied to production, we would say that we have over applied overhead. If the actual factory overhead was more than production, or more than the amount that we applied, we would say it was under applied. So with that, we'll leave you with that information right now, how we calculate the overhead variance. And again, this will become more complicated as we go on. We're going to split the overhead variance up into several additional variances. Now that we've discussed overhead variances from the 10,000 foot level, where you can simply calculate an overhead variance as being over applied or under applied, we're going to drill down a little bit further, and we're going to split this overhead variance into two components to better analyze the overhead variance, and it's going to get a bit more complicated, so let's go on. Okay, here I've created, just like I did in the previous slide, I've done the calculation boxes. And the calculation boxes are pretty key because they are responsible for helping create two additional variances, one being called the controllable spending variance, and the second one being the overhead volume variance. Now, the controllable spending variance indicates how economically overhead services were purchased and how efficiently they were used relative to our actual production. The overhead volume variance, on the other hand, is caused by producing at a level other than that was used for computing the standard overhead rate, that predetermined overhead rate. And the overhead volume variance only contains fixed costs, because fixed costs are the items that would result in the variance. Variable cost would not result in any variance, since they vary directly with production. So let's take a look at these calculations, and we can see over on the left hand side we have actual factory overhead incurred, and that's the actual factory overhead that we've incurred for the year. Then the middle box is overhead from expected volume. Now, the calculation looks a little weird, but it says budgeted fixed overhead plus our variable overhead times our actual overhead application rate. That's our overhead from our expected volume. We're not going to do anything with budgeted fixed overhead because it is fixed. But we are going to do something with variable overhead, since it varies with our basically our rate, our volume. Now, the thing you have to remember about this calculation, and again, I've done this box up here over on the top right. As I say here, remember from our previous slide that our overhead costs consisted of fixed and variable overhead costs. So we need to estimate what those costs should be at the actual activity level we achieve, because we know our activity level is going to be, we based it upon an estimated activity level, and we know it's probably not going to be the same. So we have to, number one, include the fixed costs as we incurred no matter what the level of activity is, because they stay the same. And then we have to add in the variable component of our overhead costs. So that's why we do that it looks rather complicated, but that overhead from expected volume calculation. So we compare actual overhead incurred to the overhead from our expected volume, and we end up with our controllable spending variance. Now, over on the right side, we have an overhead volume variance, and again, it's caused by producing at a level other than that is used for computing the standard overhead rate, as I mentioned before. We compare the overhead from our expected volume to the overhead that was actually applied to production, which is our actual cost driver that we used, times our predetermined overhead rate, or P. I have PDOR, it could also be POHR, and we compare the two, and we end up with an overhead volume variance. So with that, that is a drill down now on the overhead variance calculation. Now I'm going to make life more interesting by spending a little bit more time on overhead variances. Now, the overhead controllable spending variance represents the amount of overhead variance created as a result of actual overhead spending compared to the overhead we plan to spend given the actual volume of production activity, so it's adjustable. And then number two is F represents the amount of overhead variance created as a result of actual production activity being different from our estimated activity, and hence that's why we call it the overhead volume variance. Okay, now let's look at an example of calculating a overhead variance. And again, this is not an easy calculation. So we're going to go through this step by step. At the beginning of the year, Airflow Corporation set direct labor hours as its cost driver to allocate overhead to production. Airflow estimates $100,000 of overhead costs for the year, and they estimate $40,000 of our overhead cost will be fixed, and then $60,000 of those costs will be variable. Airflow also estimates our production volume will necessitate 2,500 labor hours. Now, that's basically how we're going to determine our predetermined overhead rate. Now, at the end of the year, the company had incurred $120,000 of overhead costs. Those are the actual. And a production volume that actually generated 3,200 labor hours. So let's start off with the calculations. Okay, the first thing is that our predetermined overhead rate, when we originally calculated it, is our $40,000 of our fixed costs plus our $60,000 of our variable cost divided by the original estimated 2,500 labor hours. That means our predetermined overhead rate is $40 an hour. Also consider, though, within that $40 an hour rate is the fact that we've combined fixed costs and variable costs. Now we're going to use that exact same box analysis that we did in the previous slide. And we start out with actual factory overhead of $120,000. So we have that for over on the left. Now we're going to take a look at the overhead from our actual volume. We're going to start out with, we know that our actual volume, no matter what, our fixed costs are $40,000, so we don't have to do an adjustment. However, we're going to have to determine what is the variable portion of our labor rate and multiply it times the actual labor hours used. So in this particular case, in order to do that, I need to take my $60,000 variable cost and divide it by the 2,500 labor hours, and that basically, out of the $40 labor hour calculation, my variable labor rate was $24 an hour. So I take the $24 an hour variable overhead rate and I multiply it times the 3,200 hours for my actual labor, and the overhead application rate comes out to be $116,800. So I take the $120,000 and I compare it to the $116,800, and I end up with a controllable spending variance of 3,200, and you can see my actual is greater than the overhead that should have been from my actual volume. So my controllable overhead spending variance showed that I spent $3,200 more than I should have. Okay, then we take a look at the right box and we take the 3,200 labor hours, which is our actual cost driver quantity. In other words, what was actually occurred, that had actually occurred, times our $40 predetermined overhead rate, and that equals $128,000. And what we do is we compare the overhead from actual volume 116.8 versus the overhead that was applied to work in process 128,000, and that means we're going to end up with a favorable variance of $11,200. And if we combine the two variances together, we have over-applied overhead of $8,000. So what this says here is we had applied $8,000 of overhead. We had over-applied $800,000 of overhead. This is a result of producing at a higher volume than we anticipated, and that's in our overhead volume variance. However, some of the volume variance was offset due to the fact that we spent $3,200 more than we should have at the actual volume level. So that is the into this particular calculation. Now we're going to go on and see some other magical items in standard cost. We're going to do a exercise now regarding standard costing. This could be similar to something, if you found a standard costing exercise, this is the information, how it would probably be presented on the CPA exam. We have a situation here where we have direct materials, direct labor, and overhead, and we have standards and actual. So basically we have the standards that were created and then the actual production results. Direct materials, we had standards of 600,000 units that should have been used that should have been used at $2 each. Actually, we purchased and used 700,000 units at $1.90 each. So basically the amount of units that we purchased and used was different than the amount that we should have used, and so is the purchase price. Direct labor, we basically our standards for our level of production says we should have used 60,000 hours and we should have paid $7 an hour for that labor. Actually, we used, instead of 60,000, we used 65,000 hours at $7.20 an hour. So we actually spent more in this case. Overhead, $8 per labor hour was incurred based upon the expected number of 50,000 labor hours. So our cost driver is basically labor hours. Our overhead rate is composed of variable cost of $6 per hour per labor hour and $2 per labor hour, and that adds up to our $8 per labor hour. Now, our actual costs for overhead, variable costs that we incurred during the year were $396,000 and fixed costs were $130,000. So now we're going to do the calculations, and I'm also at the same time going to show you the journal entries that also accompany the calculations. First of all, we purchased and used 700,000 units at $1.90 each. And you can see here our materials at actual cost. Materials that were purchased, $700,000. It actually cost us $1.90 per unit. So the actual material cost was $1,330,000. Now we're going to have to compare that to the materials at standard. In this case, the standard cost was $2 each. So we take the $700,000 pounds of materials or units that were purchased, we multiply it times our standard cost, and the amount that it should have cost, or we expected it to cost, was $1,400,000. So there's going to be a difference between the two, and we can see here that the difference is going to be approximately $70,000. The question is this favorable or unfavorable? And in this case, we spent less than we expected, so it is going to be favorable. So there's our $70,000 with a favorable variance. Now these are the journal entries, and I'm assuming right now that I use cash to purchase my materials, labor, and overhead. So I have a cash account. So I spent $1,330,000 for this particular item, or for these particular materials. The debit then is, remember, I put everything in at standard cost, whether it be materials or work in process or finished goods, they all go in at standard. So I enter raw materials for $1,400,000. And then the offsetting entry then is a credit to purchase price variance for $70,000. It's a separate account. So that amount is extracted out of the, as basically input back into the purchase price. Now, here's something else, is that any variance account, if I have a favorable variance, it will always be a credit to the account. If I have an unfavorable variance, it will always be a debit to the variance account. So keep that in the back of your mind. Now let's calculate the materials usage variance. And the first thing we're going to do is calculate the actual materials that we used in the production process. And remember, we're going to value them at standard cost because we've already extracted the actual cost out in calculating our material purchase price variance in the previous slide. So according to the chart here, we actually used 700,000 units. Now, if we do our actual materials used calculation, we take the 700,000 units, we multiply that times our standard cost per unit of $2 per unit, and it comes out to the actual material used based upon the standard cost of our material is $1,400,000. Now we compare that to the standard materials used, or when I say standard materials, the materials that we expected to use with this current production level, and we value them at standard cost. So materials that should have been used per our standards were 600,000 units. The standard material cost is $2 a unit. So the value of the materials that should have been used at standard was $1,200,000. The comparison of the actual materials versus the standard materials used was a total of $200,000, and since we used $200,000 more actual materials than we had expected, we end up with the unfavorable variance of $200,000. Now let's see how we record this transaction in the general ledger. We start off with the materials used, the standard materials used at our standard cost of $1,200,000, and you can see we debit work in process for $1,200,000. We also know that the actual materials, the materials that we actually used, was valued at $1,400,000. So we have to remove that amount from raw materials, and you can see the credit to raw materials of $1,400,000. And by the way, that leaves raw materials with a zero balance. And lastly, we have to record the material usage variance. In this case, it happens to be an unfavorable variance, $200,000. So we debit the material usage variance for $200,000. And you'll remember what I had said earlier, that if we have an unfavorable variance, that will end up as a debit in the variance account. If we have a favorable variance, that will end up as a credit in the variance account. Now let's record the labor rate and efficiency variance. The first thing we want to do is calculate the actual payroll paid, which is our actual labor hours at our actual labor rate. So that's the left box. So we're going to have 65,000 hours paid at $7.20 an hour. And we show that calculation there. So the actual labor cost for payroll, our actual payroll, is $468,000. Now we want to compare the actual labor hours that we did pay, but we want to convert those actual labor hours from the actual labor rate to the standard labor rate. So we pick up our standard labor rate, which is $7 an hour. We multiply then the $65,000 or 65,000 actual labor hours times our standard labor rate of $7 an hour, and our labor cost at standard is $455,000. So the way of looking at this is that we actually spend $468,000. Based upon our standards, we expected to spend $455,000. So we spent more than we expected. So that'll leaves us with a labor variance in this case of $13,000. The difference between the actual and the expected. And since the actual was higher, it's an unfavorable variance. Okay, now what we want to do is we want to take the actual hours that we calculated at our standard labor rate, and we want to compare that then to the standard hours that it should have taken to complete the units in production. So in this case, our standard said that we should have taken 60,000 standard hours. So the standard labor hours that should have been incurred to make the units was 60,000 hours. We multiply that times our standard labor cost per hour, and it comes up to $7 an hour. So the difference in this case, or rather the difference, the total is $420,000. So now we compare the actual amount basically of labor hours at a standard rate of 455,000 compared to our standard labor hours at our standard labor rate of 420,000, and our actual hours then exceed our standard hours, or our actual cost exceeds our standard cost. So the difference is $35,000, and therefore that's an unfavorable variance. Now we have to determine how we actually calculate those variances. So let's start out with our standard labor cost. In other words, our standard labor hours at the standard labor rate. In other words, the standard cost that goes into work in process. So it's $420,000, so we debit work in process for $420,000. Next, we record the labor rate variance of $13,000 unfavorable, and you can see the debit to the labor rate variance account of $13,000. Next, we record the labor efficiency variance, and it's $35,000 unfavorable, and again that becomes a debit to the labor efficiency variance account. And remember, as I again mentioned before, an unfavorable variance goes as a debit to its applicable variance account, while a favorable variance goes as a credit to its applicable variance account. We also have to record the amount of payroll we paid. In this case, we're assuming we paid payroll in cash, and it would be $468,000. And if you do a quick computation, you'll notice that our total debits to work in process, labor variance, and labor efficiency variance equal our total credit of $468,000 for cash. Let's talk about spending and volume variances relative to this problem. The first thing we need to do is calculate the actual factory overhead incurred. And the way we're going to do that is we're going to look at the actual hours portion of the problem and look for our cost. And we see variable cost incurred $396,000 and fixed costs incurred of $130,000. So we add those two together. So our actual factory overhead costs incurred are $526,000. Now we want to calculate the overhead that we should have incurred from our actual volume. And we do that by starting out by taking our fixed overhead, which will be $130,000, plus the portion of the variable cost portion of our overhead application rate, which is $6 per hour, times the standard overhead labor hours. And in this case, the standard labor overhead hours, if you take a look under direct labor under standards, would have been 60,000 hours. So we take the 130,000 plus the 6 times 60,000 standard overhead labor hours, and the total comes up to $490,000. So we have a controllable spending variance, and when you do the comparison between actual and the overhead from actual volume of $396,000. And it's unfavorable because the actual overhead we spent more than was called for with the overhead from our actual volume. Now we have to calculate the overhead that was applied to production, and we do that by the standard hours that were going to be used to apply to production, which would be 60,000, times our predetermined overhead rate, PDOR or POHR, and that's $8. So 60,000 standard overhead labor hours times our predetermined overhead rate is 480,000. So we compare the overhead from actual volume was 490,000, and the amount that we applied was 480,000. So we have an overhead volume variance equal to $10,000. And again, we applied more, or we applied less than we should have, so it was $10,000 unfavorable. So we combine these together, and they basically come up with our either overhead under applied variance or our over applied variance. So in this case, both of these variances added together would be $46,000 under applied. And what this is saying is the company under applied $46,000 of overhead, which really means that we spent $46,000 more than we absorbed into work in process. So the company underapplied $46,000 of overhead. This is a result of producing at a lower production volume, which was which is worth $10,000 than we had originally anticipated, and we spent more than we anticipated, which was $36,000 at the budgeted level that we achieved. Now let's go on to one other slide regarding our spending and volume variances, and go and take a look at some of the how we would work the journal entries on these. Okay, again, what you see here in terms of the 3-box presentation with the variances is the exact copy from your previous slide, and we see below the general ledger accounts are going to be involved in this. Okay, now first of all, you'll notice I don't have any variance accounts because typically controllable spending and overhead volume variance accounts are not included as general ledger accounts because they're typically only calculated either at a quarter end or year end or things like that, and they're for information purposes only. So in this case, we have 3 major accounts where the entries are recorded: cash, work in process, and manufacturing overhead. So if we start out with our manufacturing overhead during the year, we spent $526,000 on overhead costs. And you can see there's a debit to the manufacturing overhead account of $526,000, and there's a credit to cash of $526,000. So that represents the journal entry that would have been made regarding manufacturing overhead. Now, overhead that was applied to production via our standard labor hours times our predetermined overhead rate was $480,000. So during the year, based upon our standard production, we had $480,000 that was applied to work in process, and our credit goes to manufacturing overhead in the amount of $480,000. So now you can see in work in process, you can see our material inputs, you can see our labor inputs, and now you can see our overhead allocation. The other thing is, you can see with manufacturing overhead there is a difference. We have a manufacturing overhead of actual cost of $526,000, and the amount that we have allocated to work in process of 480,000. And interestingly enough, of course, that is the difference between the two is $46,000, and that is the under applied overhead. In this case, if this amount was considered to be immaterial to the financial statements, we would close the manufacturing overhead account out to the cost of goods sold account. So we would, in order to zero the account out, we would make a credit to manufacturing overhead and a debit to cost of goods sold. Let's attempt this standard cost variance simulation. In June, Chimney Sweep purchased 8,000 pounds of raw materials and purchased it at $9 a pound. The standard cost for the materials was established at $7.40 a pound. During June production, Chimney Sweep's actual material usage was 10,000 pounds, while its standards called for the use of 10,500 pounds for the production volume that they actually achieved. June production involved actual direct labor cost of $82,500, so that's their actual payroll, and they paid 7,500 direct labor hours. Standards for the June level of production called for 6,000 direct labor hours to be paid at $12.50 an hour. Overhead is applied to production at $2.25 per direct labor hour. Of the overhead application rate, $1.50 per hour is considered variable, and the remainder, which is 75 cents per hour, is fixed. Actual factory overhead incurred in June was $16,000, and you're asked to calculate the variances, the following variances, and the amount in favorable versus unfavorable. For the sake of learning in this problem, what we're going to do is we're going to calculate the first, I'm going to ask you to calculate the first two variances, and after we do that, we'll go over the solutions for material price variance and material usage variance, then we'll go on and talk about the other variances. So at this point in time, you should stop the video and attempt your variance calculations. And when you're ready, restart the video for the variance calculation answers for materials. Okay, the answer to material purchase price variance, we're going to see it's $11,800 unfavorable variance. We'll notice the first thing we have to do is compare our actual purchase cost at actual cost times the cost, the actual purchases, if it had been valued at our expected cost, our standard cost. So the actual purchase cost is the 8,000 pounds times $9 a pound, $72,000. Now we want to compare that as if we purchase the same amount of pounds but at the standard or the expected cost rate. So it's 8,000 pounds times $7.40, and that means our total cost should have been, if we purchased at the expected cost, $59,200. So the difference, the variance, is $11,800. The reason it's unfavorable is because we paid more in our actual cost than we expected to, given our standard cost. Also, let's go on to the material usage variance, which is part of. Okay, the answer to materials usage variance, it's $3,700, and it's favorable. And our calculation to arrive at this is we take the actual materials that we used at our standard cost. We see our actual material usage was 10,000 pounds. That's what we actually used, times $7.40. That value is $74,000. We compare it to the standard materials. In other words, the materials we expected to use at that volume level times our standard cost, and that equals 10,500 pounds worth of materials that we expected to use times $7.40. So the total value of the materials we expected to use was $77,700. So the difference between these two is $3,700, and the reason it's a favorable variance is because we actually used less materials than were called for, than were expected to be used. Okay, let's go on to the next slide. Okay, in this slide now, what we want to do is we want to go over the labor rate variance and the labor efficiency variance, the amount and the amount, whether it's favorable or unfavorable. So go ahead and read what you need to read on the slide. Stop the slide, and when you're ready, restart the slide for the answer for the labor variances. Okay. In our labor variances, we had a labor rate variance of $9,250, and it was favorable. And we had a labor efficiency variance of $18,750, and it was unfavorable. So let's see how we arrive at those calculations. Okay, the first thing we know is the actual labor. We want to calculate our actual labor cost, and it's our actual labor hours used at the actual labor rate. But in this case, we don't even have to calculate that because we're told our actual direct labor cost for payroll is $82,500. So we insert that in the actual cost box. Now we want to take the actual hours that we paid and we want to value them at our expected labor rate or our standard labor rate. Okay, our actual direct labor hours paid were 7,500 direct labor hours times our expected rate, which would be $12.50 an hour. So in this case, the total comes up to $93,750. So here we look at the actual hours paid, which was 82,005 versus the actual hours, or the actual amount that we expected to pay at the expected rate of $93,750. That means we end up with the labor rate variance of $9,250, and it's favorable. Okay, then we go on and we compare the standard labor hours that should have been incurred at the standard labor rate based upon the amount of volume we achieved. In this case, what we're told is the standards for the June level of production called for 6,000 direct labor hours. So in this case, it was 6,000 direct labor hours times our expected cost per labor hour of $12.50, and that comes out to $75,000. So in this case, in the comparison, we have a labor efficiency variance of $18,750, and that is an unfavorable variance because we spent more in our labor hours than basically than was called for in our standards. Okay, now we want to go on to the last portion of our standard cost variance simulation, and that's calculating the overhead spending variance and the overhead volume variance, the amounts and whether it's favorable or unfavorable. So go ahead and stop the video, and when you're ready, restart the video for the answers. Okay, now we take a look here and we see our overhead spending variance was $250 and it was unfavorable, and our overhead volume variance was $1,125 and it was favorable. So again, here's how we do the calculations. We have to find the actual factory overhead that we incurred during the year, and we're told the actual factory overhead incurred in June was $16,000, so that goes to that box. Now we have to take the overhead computed at our actual activity. So we start out with our $4,500 fixed overhead rate, and we're going to add to that then the $1.50, which is a variable overhead portion of our predetermined overhead rate, times 7,500, the actual labor hours. So that equals $17,750. So in this case, we spent $16,000 and we should have spent $15,750. So our controllable spending variance is unfavorable to the amount of $250. Now the overhead applied to work in process happens to be the 7,500 labor hours times our predetermined overhead rate of $2.25, that equals $16,875. So our overhead volume variance, and the difference is $1,125, which is a favorable variance. I forgot to mention also, with the overhead computed at actual activity, you do have to split the overhead variable cost component from the overhead fixed cost, and I do the calculation where I've done the split there.